Steve Mueller, CEO of Southwestern Energy, thanks for joining me at IHS CERA Week.
Thank you.
Big discussion around here all this week has been that many companies have had to reduce capital expenditures due to lower prices. You've had to reduce CapEx by about 20%. At the same time, your production levels have been rising every year. You're committed to some low-risk drilling this year. Can you maintain those production levels even as you're cutting CapEx?
Well, we think we can. If we invest the same as we do this year, about $2 billion for the next 3 years, we think we can grow at least 8 to 10% a year each one of those years. And for us, we're almost 100% natural gas company. We've had tough prices for a while, so we've been in this for a while.
You have recently sold some assets to pare down some debt. Are you going to continue to sell assets, and would you be interested in being on the other side of the equation and buying any assets?
Well, part of the reason we're paring down assets is we did a big acquisition at the end of the year. It was a $5 billion acquisition. And so part of the funding of that was selling some assets, and we announced recently that we sold 2 small conventional properties in a pipeline system. You may say us do a little bit more. Part of this acquisition that we bought has some wells that really don't fit what we do. They're more conventional. We're more an unconventional player. But our sales are pretty much done.
In terms of potential future acquisitions, how attractive is pricing right now?
Well, certainly, like I said, we just did a $5 billion acquisition, and I think we were very fortunate. We found a willing seller and a low gas price. And a lot of times you don't have a low commodity price and still have a willing seller as you go through it. So they're out there. We just did one. For us, $5 billion is an awfully big acquisition, so you're not going to see us actively working on something that size again. And I think towards the end of the year, you may see more activity in the industry. You're starting to see a little now, but I think it's more towards the end of the year.
You have, in a recent investor presentation, factored in nat gas prices at $3 when you were making some assumptions for the year. They're below that, so I'm wondering what that means for your cash flow, being that prices are not at that level.
Right. And you know, the whole trick is always, what is your cash flow going to be for the year? Part of what we do is we hedge, and part of our hedge is the midstream system we have that's based on volume. Part of it's physical hedges. So we have about between 40 and 50% of our cash flow hedged, and so we know that's going to be there. And then, as you said, price makes a big difference. Today, prices is acting a little bit better than it did in 2012. 2012 ended about 286. So we're watching it. If it continues to stay low and gets worse than 2012, we'll have to adjust some things again. If it stays in the same range as 2012, we're going to be around that $3 number. We'll be fine.
One bit of conversation around CERA Week has been that with oil prices low, we've seen some production projects put on hold, and the idea is that there's all this product that will start flooding the markets again once prices rise. Do you have any thought on that, especially in the shale plays? What is going to start happening once prices do rise? And if all that production floods back in, then of course you can have prices fall again.
Well, there certainly is a lot of money on the sideline today that would like to invest. And they're trying to figure out, do they invest in acquisitions, do they invest in drill bit, and when do they invest? And I think that'll all be played out over the next 6 months. But certainly, we didn't need the rig count we had before on the oil side. It needed to go down a little bit anyway. It's gone down in half now. And then what causes it to go back? Another $10 to $15 in gas price, and I think you'll start adding rigs, and you'll have the typical yin and yang oil and gas business where you drill a little bit too fast, prices go down too much, you slow down and go back and forth. And I think we're in that cycle. We've
seen a lot of job losses in this industry overall, in the energy industry. You actually have a few dozen jobs posted on your company website, so you are hiring this year.
We're still hiring, yeah. And again, we're almost 100% natural gas company. We've had low prices for a while. We've designed our company to work fairly well in the low gas price environment. And with this acquisition that we just did, we have some very specific jobs that we're looking for, and we're looking, as people lay off good people, this is just like it being a good time for acquisitions, a good time to find some good people. So we're keeping our eyes open there.
How's your integration going with that acquisition?
It's going really well. We'll talk more about it on our earnings here later, but just one thing I can pass on is that we're drilling wells about 5 days faster than we thought we were going to. We thought we'd build about 25 days a well. We're doing them in 19 already. And so that's already kind of accelerated that whole process. So it's going well right now.
Steve Mueller, great to talk to you. Thank you so much.
It's very good talking to you.